And welcome back to WealthWise with me, your host, Jordan Kimmel. And I saw him over the weekend. You did too. It's Jacob Sonenshine from Barron's, and he is the stock pick writer, which is what we love. And so, Jacob, first of all, thanks so much for joining us.
Thanks for having me. I am a stock pick writer with a team of really good people.
I'm going to call you the stock pick writer for us, but you're a stock pick writer. I know there's lots of talent at Barron's. It's a great publication for many, many years. And it's nice to see them refreshing with new names, like yourself. I appreciate your humbleness. But, the thing that most interests me about you in our discussion now is we've morphed into this world of ETFs and sectors and people who aren't looking at individual stocks. So let me first share some good news for us at Pro Investor Insights. You'll be joining us now. We'll be including your articles. I'll give a little bit of an insight later on in the segment to what we just saw from you, because we won't come out till the 15th. But what I want to do first is let me let you just kind of riff on what you see in the market. I see a lot of heat, a lot of maybe potential blow-offs. I know that's not what you look at. You're looking at companies that you can invest in rather than buy at 11 and trade at 2. So tell me what you're seeing overall, and then we'll get into some of your ideas.
Yeah, I mean, for the overall market, the composition of the S&P 500 lands it at a pretty expensive 22 times earnings, maybe just a hair under. When you have rates above 4%, 22 times earnings is a little bit inappropriate because first of all, just the correlation between multiples and rates historically, it just you should demand more return in equities than what you have to pay right now. That's just where the S&P 500 lands. Small caps are much cheaper for sure. But the way the market is trading now is the entire market right now has become much less of a macro trade. You have to look really hard at sector and sub-business trends in order to really understand the way the market's trading. Like when I look at, for instance, when I look at NVIDIA, which I understand it's this $3 trillion AI poster child, it is an individual company run by a set of human beings called the management team. And when I looked at the way NVIDIA traded last week, and it's down about $10 from more than $10 from its all-time high. It's at 137 last I checked, or maybe down 11. It came into earnings having rolled over for a few months, but still with an enormous run over the last few years. It is trading at a more depressed PE than it had been at the peak, but it's still, that PE is still reflecting a pretty good growth of earnings long term. But for NVIDIA, for people to continue to buy, because everyone had loaded up, for people to continue to buy, you had to have everything go perfectly. I think one of the wrinkles on that earnings call was when management said that gross margins for Blackwell, the new AI chip, would be in the low 70s in the near term rather than the mid 70s in the near term. It could get to the mid 70s, but we're not there yet. And so now the market has to worry, how much downward momentum is there in chip pricing for Blackwell, with AMD, one of my favorite stocks, coming into the market, creating supply pressure. And so the point that I'm making is that if you look at specific companies with a lot of stuff up in the last few years, everything has to go perfectly for the stocks to trade up. Didn't happen with NVIDIA, but we have seen other stocks trade up when they report good news. So the way the market is trading right now is stock to stock, industry to industry, and it's less of a macro trade.
Right. And so let me kind of add on to something that what you talked about, because PEs, especially in semiconductors, sometimes when the PE is low, it's not the right time to buy it. And then they take charges and whatnot. Why I mentioned in my book here, Magnet Investing, is that price to sales, intra-industry and within the market cap, is actually a better macro way to look at companies. Price to sales, Nvidia is expensive. I don't care what the PE is, but price to sales is over 40. The price to sales of ARM is over 40. Price to sales of other semiconductors are a tiny fraction of that. And what makes me laugh, Jacob, is when people say now, right now, Nvidia is the single greatest opportunity to buy. And it tells me they're talking to amateurs. And people forget that Nvidia was down some 70% in 22. You didn't hear people foaming in the mouth about Nvidia when it was down 70%, right? Now it's up, and a little of this, unfortunately for the public, has to do with distribution, where people begin to distribute the stock to the public. I think this is happening, and super long term, when the biggest story is robots, they very well may dominate the robot market. The question is this a good entry point for NVIDIA? I will admit it's not even in my portfolio anymore. So that's how I think of NVIDIA. And let's take it
Yeah, I
one
mean,
step. Go on.
you're the second person in a week to tell me I don't want to buy Nvidia at this price. And I don't think like I actually think because it's rolling over, in fact, more than rolling over, now it's taking that little bath. Um, it's getting more attractive, but it's not, as you mentioned, it's absolutely not cheap relative to the risks that the growth is going to be there, but the market's trying to figure out like, is there a little bit of negative momentum on pricing and gross margin? How much are they investing? Because they're not looking for a massive operating margin ramp, these types of things.
Right. So let me go to what is interesting, and what is really interesting to me is you've joined us before. You gave your best idea, and we think someone was listening because right after you recommended Domino's Pizza on our show, we heard Mr. Warren Buffett and Berkshire Hathaway took an opening position. So maybe he's watching the show, maybe he's just listening to you. But hey, it's great to see people who are willing to go into names that are maybe just turning around, maybe haven't been in the spotlight for the last 6 months, and showing new ideas from, instead of the single most talked about. Everyone wants to talk about Nvidia. It's my belief, Jacob, when everyone's talking about something, uh, it's not the opportunity to make money. And I know you're a little younger than I am. There was once a time where you couldn't get on the internet without AOL. AOL was the only stock to own right before it lost 80%. So it's super important. Entry points are almost as important as anything else to me. So let me share this. You gave us a new idea uh, for our next newsletter. It won't come out for a little while. I think you've gone public with the idea. Do you want to share pin interest or pins? I'm not even sure how to word it, but had been a sensational high flyer, came way down, started to turn, and that's, I see, where Jacob gets interested. So why don't you share your thinking behind pin interest, and if I'm even saying it right?
Yeah, Pinterest. Yeah. Yep. And I liked Pinterest in April of 2022. Sorry, April of 2023, March, April, somewhere around there. And it surged and then just kind of did a round trip. And it's got a few problems in terms of sentiment on the stock. And right now, if you're a small cap stock, you better execute because there is still, even though small caps have begun to break out, there is still a little bit of a discount just in terms of the level of valuations today for small caps. There's still this discount put in for smalls, and if you're a small cap that doesn't execute to the market's expectation, you're going to get hit. I think it's an opportunity. Yeah, exactly. And I think it's an opportunity to buy Pinterest because I do believe in the business, and the business has not only proven in the past that it can grow pretty rapidly, but it's also got a CEO, Bill Reddy, that is extremely experienced in internet and tech. The thing with Pinterest, it got knocked down in the last quarter. The company has talked about doing 15 to 20% revenue growth. It is only doing a few billion dollars in annual sales in a digital ad market that is worth, we know, probably close to $100 billion globally annually. So we know that if Pinterest can maintain pretty good engagement of users on the site, if it can attract a few more advertisers to the platform, just a little bit, just taking a little bit of that global market share will do wonders for this smaller company from a revenue standpoint. Most of the growth expectation comes from average revenue per user. You're trying to get more ad load onto the page and higher ad prices. Company's doing all the right things to do that. It is when you go on Pinterest to look for ideas for your home, for your kitchen, your bathroom, food. I'm a big foodie. Little trinkets and stuff like that. You can click it. The site enables you to click right through and transact and buy. And there are a lot of users and a lot of products and a lot of ideas. So it's a big field of ideas for people. And so I think the ad load, number of advertisers, and ad prices, especially with the company's use of AI and knowing what people want, those all go up. Your ARPU expectation, average revenue per user, has been going up double digits year over year consistently. It's still at about roughly $10 ARPU annually. To put that in context, Meta's at 50. So if you're trying to feel comfortable that there's more runway, yeah, you don't have to get to 50 to satisfy investors in terms of ARPU, but you can get there. So why did the stock go down after earnings in Q3? The guidance called for about 16% revenue growth. And, the difference between 16 to 18% revenue growth is fairly big in terms of revenue dollars. And then if you don't exercise great cost discipline, it has really bad margin consequences. And that's why the stock got hit. Also, then the multiple on if you want to look at price to sales gets hit a little bit because then you're worried about longer term growth. When you have a story where the market is
Yeah.
asking, where the market is asking, do we think we're getting 16% revenue growth or closer to 20%? That's when you want to be a bottom feeder and go buy a stock that is already de-risked for slower growth, because you're either going to get that growth, which is pretty good, and the company, you can expand margins pretty easily with 16% revenue growth,
Right.
or the company can get back towards 20%. And the last thing is the cherry on top. Why can I get to 20%? Because excluding the food segment of advertisers on the site, the growth was above 20%. We know that consumer packaged goods and food, Pepsi, Coca-Cola, have been struggling. They probably, certain products probably pulled back on ad spending. If that segment can get kind of back up and running a little bit, you actually are at closer to 20% revenue growth. So I'll stop there, but you're getting a stock that's de-risked, that's still growing, and could get back to the glory days of closer to 20% growth.
Right. Well, you know what, Jacob, if Warren's listening again, you're talking about margin of safety. And that's what his whole program is about, margin of safety. Not how much can I make if everything goes perfectly, but how much am I going to lose if things don't go perfectly? So it's a real example of you doing your homework. I want to add one other thing on that because we think sometimes that the reaction is rational, whether it's good or bad. I'm going to make a comment that a lot of what's going on right now is algo trading. These aren't even human beings. They're tripping over each other. If the moving average is above the moving average, it's above, keep buying, buying, buying into insanity. If it's below the moving average, if there's a certain word that's mentioned, the algos will sell them indiscriminately. And I'm a believer that these algos are now creating danger. They probably are the next case for the next flash crash, whatever you want to call it. When the algos run the systems and the managers are taking a back seat, we have problems on our hand. So let me take one more step towards what you were saying, because you hear, and it kind of bothers me. People say small cap, large cap, small cap. Well, last week we saw in one sector, in one industry, we saw Walmart, Target, Williams Sonoma, all kind of announced. So it wasn't whether the consumer's this or that. It comes down to individual stocks and individual execution. And it brings me to an idea I want to share, and I just want to bounce it off you. Um, all of a sudden, these weight loss drugs became, a mania. And I'm not saying they're not good, but what happened is Eli Lilly, which is a super large cap, big pharma company, began trading at 100 times earnings and a price to sales multiples of every other company. And I said, this is Eli Lilly. What are they doing here? So Eli Lilly, to me, honestly, looks like a short. I'm not saying a perpetual short, but it got too high. And I shared on Fox a couple of weeks ago, Hims and Hers, uh, smaller cap company, also involved in weight loss, hair growth, uh, improvement in the bed. This is what's called the magnet stock. It's got value, growth, and momentum. So what I'm going to do with pins is I love the fact that our newsletter contributors and our guests onto WealthWise are all sharing their ideas. I'm not going to buy pins today. I'm going to actually put a price level where I think the momentum is turned just a little bit more. And but I love the fact that you're bringing names and talking about the research you're doing. Let me open it up. Anything else on your mind at all, Jacob, you want to share?
Well, I mean, you just brought up a lot of, really good points. And as you were talking about algorithmic trading and volatility, look, like if 3 to 5 years from now we have the benefit of hindsight and we can see that Pinterest is worth $30 billion, not less than $20 billion, we would say, great, like it was a great buy it's at 30 today, which is down, a lot from before earnings. But nobody wants your first move to be down or like a lot, or your first move to be significant underperformance. You don't want that to happen because maybe things don't come back the way you hope. And so part of that, as you mentioned, was algorithmic trading. And when a stock gets knocked to certain levels, then it becomes a real prove me story before trading turns positive again. So as you were saying that, I looked up the just the VIX. Um, and when you go back to before the financial crisis, and we know at that point, things were just technology in general was way less advanced than today. Well, the VIX before the financial crisis was finding a bottom around 9 or 10.
It's real low.
Uh, doesn't does not smack of anything that sounds familiar today. The VIX finds a bottom these days, we'll call it post-COVID, not at 9 or 10, probably somewhere around 12, 13, 12,
13,
around
yep, yep.
12. I mean, look, I'm not a scientist, I'm not a data scientist, but I think to your point, we are in a higher volatility regime. And part of that is COVID disruptions that are still sort of like implicitly part of the economic and financial market landscape. But the algo stuff that you're talking about drives so much volatility that I can totally understand that even though I'm saying I think Pinterest is a great value at 30 a share, you're saying I'd like to see it break out to 33 or whatever target you have.
I'll take a look at it. I'm not really sure what it is. I like the idea. The point is that I run concentrated portfolios. We only allow 20 to 30 stocks in there. So they have to have this combination of value growth and momentum. And sometimes you can have companies which are really good ideas, which take a couple of years to get back into gear, even though they're great companies. And so let me actually bring up a name that I saw on Barron's couple months ago. Is one of my stocks that I did amazingly well a few years ago, Generac. So
Oh
Generac,
yeah.
if you own a home and you have a generator, almost invariably you own a Generac. Well, it was mentioned on Barron's really close to the bottom, and it actually had a pretty low magnet score. But I said, maybe it's time to enter this thing. So once the momentum came in, and once a couple of higher bottoms and higher tops showed up, it begins to get a better magnet score because we do insist on value growth and a little bit of momentum. So I think that the thought pattern that you have is excellent. And I think that in terms of what Barron's tries to do, they're not chasing the hottest thing at the moment. And I love the fact that they brought you in, who's doing some fundamental work and bringing up names that other people aren't. And so, I want to bring up one other thing.
And
So
let me
I
just say
use
quickly
a
about Generac.
mathematical. Go on. Yeah,
I'll just say about Generac, I don't know
please.
I don't know exactly who it was, but I am pretty sure it was my colleague who sits directly next to me, Al Root. And then I actually did Generac once or twice, not at the bottom, a little bit above it. I did Generac
Good.
around 90 or 100 maybe. But I love Generac, and you've seen what the stock has done. And I mean, there's absolutely nothing wrong with saying something's gotten a little bit of momentum, but valuation wise, if there's more runway on a good execution, go for it.
Right. And so I want to bring up one other thing because I do use a mathematical model, and I came across this thing, MicroStrategy, and it is one of the lowest ranked stocks in my model. But you can't short just because you think something is not highly ranked. Well, the momentum that came into this is breathtaking, and so was the move, frankly, with Bitcoin. But the point is, these things experience a blow off where they get every little last person in, and I'm going to admit that we're trying. We've had a couple of different stabs at MicroStrategy to go short, and I just think that what happens is when the algorithms are buying these things, they don't care if the moving average was 100 and it's now 400, which is the case of several stocks I'm seeing. And it's about of not having this FOMO, which everyone talks about, this fear of missing out. And people will just not do the homework like you're doing. And I just caution everybody, use a little bit of fundamental and use a little bit of your head, because we're in a moment right now where the algos really don't care about anything. What do you think of that?
I mean, absolutely. I mean, first of all, I have to be honest. When I hear about individual investors buying Nvidia or Tesla or whatever, and like they're just like maybe they did a little homework on it, but not a lot. I really have no idea why you would buy any individual stock unless you really know what you're getting into. I actually understand if you're going to chase the S&P 500 because you don't want to miss the market rally and you need to own equities for your life. I get it. I mean, you should still be prudent, but I kind of get it. But a specific company, you don't know what the chances that the human beings running the company will mess it up or grow it. You got to know. So I don't understand when people do that. And also, when you do fundamental analysis, it's more interesting. You do more work, you learn more about what's going on, you learn what makes a winner, what makes a company that isn't such a winner. The other thing I'll say about MicroStrategy is that I don't know anything about the business, but when you look at the chart, you the last time it had a parabolic move somewhere around the early 2000s, what happened? So again, not knowing the business, but like look at like I think the only two examples I can think of stocks that had a parabolic run and then didn't all out collapse are Nvidia and Eli Lilly. Now, if you shorted Lilly at the peak, you've been on target and you've had an opportunity to take some profits. But outside of Nvidia and Lilly, I can't think of any stock that has a parabolic move and then gets more money moving in. MicroStrategy most
Right.
likely is not going to get more money moving in at an $82 billion market cap after a parabolic move.
Well, let me just share with you real quick. There's business strategy is to issue lots of bonds and buy Bitcoin on margin. And that's their strategy, and their business loses money. And so when I think that's kind of comical, I have a son who's way smarter than I am, and he says to me, "Hey, Dad, Michael Saylor is much smarter than you are, so be careful. You're playing with fire." And again, what I'm going to mention to everybody, both long and short, no matter how convicted I think I am on any idea, I do use stop losses, and I only try to allow myself to lose a certain amount when I'm wrong. And I'm wrong plenty. And the major thing with me is it's not a matter of how often you're right or wrong. It's a matter of letting your profits run and making sure that when you're wrong, you don't stay wrong. And so just sharing my thoughts, but it's a pleasure to have you on, Jacob. We want to have you on frequently. And anytime you have a brand new idea that you want to share with us, just reach out to me, the staff, Todd, and we'll have you on. But I want to wish you, your family, a big Thanksgiving, a healthy Thanksgiving, and I know we'll talk to you soon. So thanks for your time today.
Thanks for having me. Yeah, happy Turkey Week.
All righty. Well, it's Jacob Sonenshine from Barron's, a stock picker writer. I think a pretty talented one. And it's Jordan Kimmel signing off from WealthWise. Everybody have a great Thanksgiving, and we'll all see you soon. Thanks again.